Single-family mortgage industry changes during COVID-19. Before we get to the panelists, I want to turn it over to Lisa with the Florida Housing Coalition to go through a few logistical items.
Good afternoon. I am your technical assistant for today's session. We have muted all participants upon entry. There are two ways for you to let us know that you would like to be unmuted and to participate in the conversation, especially the questions that will follow each presenter. So that's how we're going to do today's session, is that questions. We're going to encourage questions after each presenter. So to do that, you want to go down to the chat box and you can enter your question there. To the right of the chat box, all the way over, is reactions, and you can wave your hand or give a thumbs up that you would like to be unmuted and ask a question. And so Mark will be monitoring the chat and fielding the questions to our moderator, Sue. And this session will be recorded and will be available at the Florida Alpha website, hopefully even as soon as tomorrow. If you are having any issues hearing us, please try logging on and log back in. If you're still having trouble, please try to send me a message using the chat box. You can also email me. I will be monitoring my email during today's session. I'm going to turn it back over to Mark.
Yeah, and if people have trouble with where is the chat box, if you take your mouse arrow and move it down below the PowerPoint slide, you'll see there's a bar that opens up, but you have to move down there for it to open up. On the far left is mute, stop video, and then participants, chat, share screen, record, and reactions. And it's in that chat box that I'll be keeping open that you can type questions. And I'll get to them. But first, I want to thank our sponsors. Without our sponsors, we wouldn't have the conference, and it certainly wouldn't be free. Our platinum or host sponsors, HFAs, Hillsborough, Jacksonville, Panelists, Broward, Miami-Dade, Escambia, and Lee counties, and our three other platinum or gold, Raymond James, eHousing Plus, and RBC Capital Markets. If you could roll to the other, the gold sponsors are there, which are some of our other HFAs, move on, and some of our other sponsors that will be, if you could, silver, and our bronze and breakfast sponsor. So we thank all of those. Again, this PowerPoint has already been posted to the Florida Alpha website, and the recording of this session will be on there by tomorrow. So again, if you have questions, the preferred way is to use the chat box. Please, we encourage questions. And I want to turn it over to Sue Denihan. Thank you, Sue. If you could go ahead, and thank you for being the moderator today.
All right, thank you so much. My name is Sue Denihan. I'm with eHousing Plus. I'd first like to thank everybody for attending today. I know this is a little different. Well, this is very different than how we've done this in the past. I will say I really do miss seeing everyone in person. Hopefully by next year we can all get together again. But I see everyone's names as they're joining the conference. So thank you so much for attending today. I also want to thank the panelists today that are on the panel. We have Robyn Fiel with Synovus Mortgage, Tim Wranovix with Raymond James, and Beth Larson with Essent Guaranty. And this session we put together, we thought it'd be important to go over what impacts the industry is feeling from COVID-19. The things are changing rapidly and ever evolving quickly. It seems like for the first couple of months there, we were getting bulletins on a daily basis, either from a servicer or from lenders themselves. But I will say this, looking back, it appears now that for the most part, everyone pretty much adapted and overcame. Whatever problem was thrown our way, we were able to work through it. And the question came up, well, how are lenders working through these changes? What about mortgage insurance companies and servicers? And that's what we're here to answer today. And these panelists today are experts in their fields. They'll be able to answer many of those questions for you. So this you can kind of think of as a two-parter type of a session. On Thursday, I want to encourage you to sign up and come to the session. It's at noon. It is a discussion, once again, revolving around the effects of COVID. The moderator of that session is Carmen Lemberg. She is the Single Family Programs Operations person with the ALHFA and Panelists. And her two panelists are Cindy Hayden. She's the chair of the Board of Realtors for Pinellas County, and Sean Moss, the Director of Operations and Customer Support with Down Payment Resource. And it will fit in nicely to the conversation we're having in today. So if you're interested in what we're speaking with today, please come on Thursday as well. I want to introduce our first panelist, Tim Wranovix. He's the Director of the National Housing Group with Raymond James. He's been with that group for over 10 years in their housing and has over 10 years of housing finance experience structuring a variety of single family and multifamily housing issues. He's responsible for creating and maintaining the group's proprietary models. And Tim's primary account coverage has been many of the Florida local HFAs. He also assists senior bankers with their coverage of housing clients around the country. Since joining Raymond James, he's been actively involved in the firm's investment of bond proceeds practice. And Tim received a Bachelor of Engineering degree in Mechanical Engineering from Vanderbilt University in Nashville, Tennessee. And he holds Series 7, 50, 53, 63, and 79 securities licenses. And Tim is going to take us basically a walk down memory lane not too long ago over the timeline of what's been happening with COVID-19 and then those resulting lending issues. I'd like to turn it over to Tim now. Tim?
I appreciate that, Sue. Can you hear me?
Yes, I can hear you.
Perfect. All right. Well, yeah, as Sue mentioned, I'm going to give a high-level overview kind of timeline of what's happened since COVID and also tie that into the two normal structures that HFAs do. It's tax-exempt bonds and then also the TBA market. But first, hope everybody's staying safe and healthy, especially in Florida. As you can imagine, market fluctuations, as Sue mentioned, with bulletins coming out left and right, have been constant. Things are changing monthly, weekly, daily, hourly. However, as she mentioned, unlike in the Great Recession, the mortgage market, for the most part, has remained fairly resilient. So, quick summary, March 11th, COVID-19 was declared a pandemic by World Health Organization. March 13th, U.S. declares national emergency concerning the COVID outbreak in the U.S. And then March 27th, the CARES Act was signed into law. So the two aspects of the CARES Act that I'm really going to focus on are foreclosure and forbearance relief. So for foreclosure, HUD, FHA, and FHFA, which is the regulator for Fannie and Freddie Mac, extended foreclosure and eviction moratoriums until August 31. That may ring somewhat of a bell because a lot of articles that folks are starting to see on TV and in newspapers, et cetera, is people are worried about an eviction and foreclosure crisis maybe gearing up in September. And I'm sure that's what Congress is trying to focus on in future bills as well, because a lot of people are starting to worry about that. We'll have to wait to see if that's actually going to result. We're hoping that doesn't, and it's just the kind of worst case scenario that people were focusing on. And so far, we have not hit the worst case scenarios, which is at least good in the mortgage market. On forbearance relief, HUD, FHA, and FHFA, for borrowers that experience financial hardship due to COVID pandemic, were able to request or obtain forbearance up to 180 days with a potential additional 180-day extension. However, one note that's been highly discussed is obviously those payments still need to be paid. Confusion and uncertainty surrounding the CARES Act when it was first passed. Obviously, it's a very large bill passed very quickly by Congress, lessened the immediate impact because when it was first introduced, there was no provision for servicers that were still going to have to make those payments under forbearance. So there was a lot of confusion. Some servicers were even starting to tell borrowers that they'd have to make up those payments in a balloon payment. And obviously that's pretty concerning when you're having trouble making a monthly payment, you request forbearance and you might have to make a balloon payment at some point down the road. The other big concern that was a focus of the market were for non-bank servicers. So that's not as big of a concern for HFAs in the Florida market, who all have US Bank as the servicer. Non-bank servicers don't have access to the Federal Reserve, which is a problem if, as people were forecasting, 30% of mortgages would go into forbearance, and those non-bank servicers were going to have to cover those payments. That can add up pretty quick. Non-bank servicers just don't have quite the same reserve requirements that bank servicers do that have access to the Federal Reserve. In late April, FHFA, the regulator for Fannie and Freddie, agreed that servicers would only have to be responsible for about 4 months of payments. So that put a big relief into the market. By May, it appeared the threat of large number of servicers going bankrupt seemed to subside. And then by July, we're obviously in the middle of July right now, it seems like loans and forbearance have stabilized between 8 and 9%. One highlight I will note there is when CARES Act first passed, the thought of free money was in everybody's mind of, oh, if I claim forbearance, I wouldn't have to make my payment. But then when borrowers discussed with, lenders, realtors, servicers, et cetera, on the results of that, they realized, okay, never mind, I don't want to enter into forbearance unless I actually have to. So there were quite a few loans that we thought were going into forbearance that ultimately did not go into forbearance, which is good. The other thing I would highlight is, we have a national pipeline of loans in the TBA market, and we're not even close to that 8 or 9% of loans going into forbearance. We're more in the handful range. So that could just be the clients that we're working with, but I have a feeling it's certain loans that are going into forbearance with certain servicers. The HFA market seems to have been fairly resilient throughout this so far. The other big highlight that I know has been on the minds of a lot of HFA staff, particularly here in Florida, is FHFA, the regulator for Fannie and Freddie, implemented a 5% low-level price adjustment, so LLPA, for first-time homebuyers, and 7% for non-first-time homebuyers for loans that go into forbearance between the time the servicer purchases the loan and the time of securitization. So that's a fairly short window of time, but is it a substantial risk if you have say $100,000 loan that goes into forbearance during that time period? That's $5,000 that somebody has to come up with for that loan to stay and be securitized and sold into the TBA market or to your bond trustee. So US Bank was coming up with various ways to try to US Bank was coming up with various ways to try to implement that. One would be the lenders could pay that LLPA, but I think you'd have a massive lender revolt. A lot of lenders, if you have one loan go bad, lenders would just back out of programs completely. The other way was the HFAs pay it. Some HFAs could afford to do that. Others are not going to be able to. And US Bank, as some folks know, did offer an SRP adjustment, service release premium, to take on that risk for loans being securitized in August and after. However, I think US Bank kind of looked at the risk profile of that. If you have an HFA that doesn't do a lot of conventional loans, you have one loan go bad, that SRP adjustment will not make US Bank whole. So there were lots of twists and turns in that saga. Servicers, like I said, are generally not absorbing that risk. So it's either with the HFAs or lenders. And as a result, a lot of HFA production is tilted towards FHA, Ginnie Mae production, as opposed to conventionals. And then more recently, a lot of HFAs have halted conventional programs, temporarily suspended them until this LLPA risk, coronavirus, subsides, hopefully. So that's kind of some unintended consequences of the CARES Act. Obviously, foreclosure and forbearance relief was very much needed in the market, but how you implement that did cause some headaches in the market and has changed kind of what programs actually work right now. On the next slide, so the next slide just shows the market volatility that we have experienced. So MMD is the municipal curve used by the tax-exempt market, quote, bond spreads to determine yields. So when HFAs, back in the day, some still do, but back in the day when you would issue tax-exempt bonds instead of using the TBA market, you would use this curve to spread and quote your bond yields. As you can see in the graph in early March, MMD had reached pretty much all-time lows. So that's on the far left of the graph, pre-COVID, pre-March. COVID hits and spreads of MMD curve drastically increased roughly about 2% across the curve. So that's from 1 year out to 30 years, pretty much you see a 2% spike in rates. So clearly between mid-March and mid-April, you pretty much see no bond pricings, tax-exempt bond pricings. The very few deals that are getting done typically were non-housing, and they were essential service deals. So they were deals that just absolutely had to get done, or projects that had to get financed, and you were paying the issuers were paying a severe premium to get that issued in that kind of market because there was just fear of liquidity concerns at that point. But what's interesting is if you look at the far right of the graph, rates have steadily declined and then really gotten stable over the last month or so. And now we're approaching near all-time lows again on this curve. So issuing bonds based on this curve is becoming somewhat attractive again. On the next slide, this is just showing how we're close to all-time lows on the MMD curve in just a different way. So the light blue bars are just the range of MMD curve from 1993 to now. The dark blue, obviously, is the average, right smack in the middle. And then the red line shows what our current rates are. And this is from early July. Since then, this curve has decreased a little bit more. So as you'll see on a future slide, lots of state HFAs are slowly wading back into the market. A lot of HFAs were trying to price in March, April, and decided to delay. And then luckily, rates have kind of reversed, gone back down. So a lot of state HFAs, and there's some locals that have been able to issue bonds since then. On the next slide, this is just tying into those issuers trying to do bonds. PAC bond is one of the most efficient bond structures for HFAs to do when you're issuing a tax-exempt single-family bond. Essentially, a PAC bond is a long-term bond that is priced to a shorter average life due to dedicated prepayments paying the PAC bond before other bonds. So if you look at this graph, the red bar is kind of the demarcation between pre-COVID and post-COVID pandemic. The dark blue line is the 5-year MMD. That would be the curve that you would spread a PAC bond to based on the average life. And the light blue dots are various PAC spreads that were completed in early 2020 and then post 2020. And as you can see on those groupings, you know, pre-pandemic PAC spreads were approaching all-time lows of around just shy of 60 basis points. Post-COVID, once bonds were able to get done after about a month lag of being able to get anything done, you're able to successfully price bonds again. However, the spreads are substantially higher. They've gone from 60 basis points to 115. So what does that mean? That means your bond yield's a little bit higher. Your overall mortgage rate will be a little bit higher. However, as you can see in the far right, PAC spreads are slowly starting to come back down. There was a Florida deal we did a couple weeks ago with a very attractive spread. The following week, THDA came, that's Tennessee Housing, came, and then some more deals are slowly coming back. And so PAC spreads, which are one of the largest bonds in a tax-exempt single-family issue, are getting more attractive again and going to help HFAs issue bonds down the road. On the next slide, there's a comparison many of you have seen, or your FAs probably do periodically, comparing kind of bond structures to the TBA market. So in the first column, this is just a hypothetical $100 million standard single-family tax-exempt deal with serials, terms, and a PAC bond. What it shows is you can get an extremely attractive bond rate right now, around 2.2%, with a full spread Ginnie Mae mortgage rate of around 330, with good returns, MPVs down at the bottom. To the right of that, what's unique is due to the Federal Reserve action from the CARES Act and post the CARES Act, they've just had unprecedented pumping liquidity into the market. So they're actually buying certain kind of bonds. They're also buying MBSs, particularly on the FHA side, Ginnie Mae side. And so what that's doing is it's driven the TBA market results very favorably for HFAs. So instead of a 330 full spread mortgage rate on the TBA side, you can get down into the 2s, which is just a scene to think about, and generate substantial NPV returns to HFAs. This has been more pronounced, as I said, on the FHA side, just based on the Fed action. And the other thing is the Fed action, they're promising to keep rates low for as long as possible, say for the next year or so. Until we really have the pandemic under control. So, I mean, this dynamic could last for a while. On the last slide, this is just showing, you know, Freddie Mac 30-year fixed rate mortgages average in the US since mid-19 to now. As you can see, you have your normal gyrations, you have this huge spike in March due to the pandemic, and then just a steady rate fall based on Fed action. If you look at the far right, I mean, you're coming into 3% mortgage rates on the Freddie Mac 30-year. So many HFAs are seeing a substantial increase in FHA reservations due to these lower rates and due to the LLPA concerns on conventional loans. For instance, Lee's program, it's called the Own a Home Opportunity Program because it operates in multiple counties. They've had about 47 million in reservations since COVID, which if you think about with all the news headlines and everything else, you just would not expect to see production increase like that, just because you don't think people are be able to see homes. You know, home inspections, et cetera. But for some reason, with rates this low, people are definitely interested in buying homes. What's interesting though is only 7% of that production has been conventional. The year prior, it was about 17%. So you're seeing a big decrease in conventional production due to the LLPA concerns. The other interesting thing is earlier in the crisis, lenders were having a lot fewer options to offload their mortgages. So HFAs were seen kind of as a safe haven for lenders. But there's still a lot of uncertainty out there. So some lenders have completely dropped out of HFA programs on the conventional side, and a few even on the FHA side, just because there are so many uncertainties out there. And I can turn that over to Sue and Robyn and Beth to give a little bit more boots on the ground explanation of who's still interested in buying homes. Are they younger folks? Are they older folks? And how do you process loans during the pandemic and remote working and everything else? So those are my slides. Appreciate it.
FHA loans. So those of us who are doing them are a lot busier. It is taking longer to get them through the whole process, just because of how busy and how much volume we have. I personally have originated a few loans in a few different county programs, and will continue to do so as other lenders have left those programs. I know that right when COVID started and some lenders left the business or left doing the HFA loans, a couple did come back, as Tim mentioned, after it was stabilized and realized that they wouldn't really need to step up with the pricing adjustments. The other, another issue that we're finding is for conventional loans, it's actually harder for those HFAs who are still doing conventional loans. It is harder to get conventional approval through our automated underwriting systems. So what that means is that some of the borrowers who are trying to buy maybe a condominium their only choice generally is to go conventional, because there are very few FHA or VA approved condominiums, and it's very difficult to get them approved FHA or VA. So just to try to get conventional approval through the automated underwriting systems has been rather difficult at times. Even with someone who has a great credit score and low debt to income ratios, it's just not being approved. We also have an issue. The CARES Act created an issue with student loans going into forbearance. As Tim mentioned, many different loan types went into forbearance, and student loans is among those. And because student loans are in forbearance, the amount that you have to calculate as a lender as part of the debt to income ratio changes. So I, again, have had a few loans for that reason where the borrower can't get approved because student loan payments have to be calculated at a much higher rate than what their payments actually will be. So these are some of the issues that COVID has created for lenders. And then the last item that I want to talk about, and I know Sue might have some things to throw in, but is as the HFAs suspend their conventional programs, as a loan originator getting very little notice or no notice about these suspensions, it makes it difficult for the loan originator, because we might have a loan in process that we have not yet registered, and now all of a sudden we no longer have a loan and we have a buyer who's under contract. So these are some of the things that we're finding from COVID, but on the good side, we are busy. We are still getting inquiries. A lot of first-time home buyers out there who want to get in because they know that buying a home and having a mortgage will be less expensive than having to pay rent. And so the buyers are still out there, still inquiring, still looking for us on the internet. And so we're still here working and busy.
So Robyn, let me ask you, as far as your lending institution, or maybe your friends that work with other lending institutions, have you found that you within your lending institution, your own guidelines and requirements have become a little more strict as well? Maybe even more strict than the HFA limits, or no?
Yes. Yes. When COVID hit, for our FHA loans, our minimum credit score went from 600 to 640. And in some cases, even 660. To be able to get an FHA loan between 640 and 660 became very difficult at my institution. I know some other lenders who have done the same thing. So now, with some of the HFAs having a 640 minimum score, I know some have 660, some have 640, but with some of the HFAs with the 640 credit score, now I might look more towards that HFA product if I can use it.
What are some of the other restrictions that you've noticed that your institution may be a little more strict with that you're finding?
Well, some of the other restrictions are having a shorter amount of time where documents are valid. So for the most part, if pay stubs that you get from a buyer or bank statements that you get from a borrower used to be good. We used to be able to have a bank statement or a pay stub be good for 90 days. And now it's 60 days. So if I have a bank statement, if I have a loan that's closing at the end of July and the last bank statement that I have is the end of May, I need an updated bank statement. Whereas in the past, that bank statement is still good. So getting more documentation and.
Right. And as far as looking at people in maybe certain professions, people who are service industry people, or let's talk about maybe people who maybe have been laid off, okay, from their job. How long do they really have to wait before they've now been rehired, maybe with the same job they had before or a different job? How easy or hard is it for them to be able to get a loan for a house? What are we talking here?
So again, it will depend on how long they were laid off. It will depend on whether they have come back to the same job or have started a new job, and also depend on the type of loan that they're getting. If they're getting, and if they've been out of work for at least 3 or 6 months, and you're getting an FHA loan, you have to reestablish work history for 6 months. If you've been out of work. Now, I actually have a young man who lost his job in one industry. A week later, got a new job, and we're actually going to be able to help him because he had a very short time frame, and we are, and he's a W-2 employee, so he is making money, and we have a verification of employment. So I just saw Tim's question there, and for every loan, Tim asked the question if we're getting a second verification of employment right before the loan is closed. And so the answer is, we've always gotten a verification of employment within 10 days of closing. So 10 days before closing, you can call the employer and get the verification. Now, it has to be within 3 days of closing. So yes, we are getting another verification of employment literally within 3 days of the closing to verify that they are still there and not laid off or furloughed. Yes.
Right. Okay. And I believe Paloma had a question as well, and it was, how did their qualification process tie into the timelines, and what qualification are they doing prior to reserving? So are you a little more critical now when you look at someone, even, I mean, in everyday life with mortgage banking, but maybe even more so with your HFA clients? Are you really waiting till an underwriter looks over that file before you make an HFA reservation, or gives it a once over there that, yep, this looks like it'll work, or no?
Well, for the most part, I almost always, even pre-COVID, waited until an underwriter reviewed a file before I reserved it, because of the short time frame from reservation to certification. But now more than ever, yes. I mean, there were times that I would reserve a loan on the system before an underwriter reviewed it because I was confident that it would go through. But now more than ever, I do wait for the underwriter to review it at least once before I reserve it on the system.
Well, that is good to know.
Yes. Back to 40 hours, what underwriters are doing is they are still averaging what the income would be for the year, based on the fact that maybe for 2 months they were at 30 hours and now they're back to 40 hours, but now their annual income is not as high as it would have been had they worked 40 hours straight through.
Good. Well, the good news is people are still being approved. The loans are still going through. The buyers are still out there anxious to purchase homes. So that's wonderful news. Do I see any other questions for Robyn? Do not. Okay.
No.
All right. Well, if you think of something, we'll come back. In the meantime, I'd like to introduce you to our next panelist, who is Beth Larson. She is an account manager with Essent Guaranty for over 5 years, and she covers the west coast of Florida. She has experience in the mortgage industry of over 37 years with processing and underwriting, management, and sales background. And she has a passion for helping people into homes and always understanding the urgency of the process. And as we were talking before, you know, there's so many different factors that play into a borrower being able to receive funds for a program. One of those is mortgage insurance, right? We don't think about that. And Beth is here to talk about how COVID-19 has affected the mortgage industry with mortgage insurance. So Beth, I'm going to turn it over to you.
Thanks, Sue. So yes, you know, mortgage insurance was affected as well with COVID, and my esteemed panelist has pointed that how it affected, COVID has affected their parts of the process. And Essent is a private mortgage insurance company, and private mortgage insurance protects the lenders when borrowers default, and there's less than 20% down payment on a loan. So as you can imagine, during this time with COVID, private mortgage insurance becomes even more important to lenders when we're analyzing the risk and cost on the cost that's associated with the risk in today's environment with COVID, and when the industry is facing unemployment that hit due to COVID, and then the forbearance and the CARES Act and those guidelines. So as an industry, a private mortgage industry, we're required to put aside capital to prepare for those loans that requested forbearance, even though those loans technically maybe aren't even delinquent at the time. So, you know, back in March when COVID hit and forbearance was put out there with the CARES Act, a lot of borrowers raised their hands and said immediately, you know, ask for that forbearance relief. So as an industry, private mortgage insurance industry, we're regulated and we're required, if those loans were even tagged for forbearance, we're regulated to put aside capital to be prepared in case those loans have a claim or go into default, so that the lender and the borrowers are protected later on down the road if that is a foreclosure. So the uncertainty of employment and COVID have certainly negatively affected the PMI premiums going forward for borrowers. So that's been an impact in the industry. You know, Essent and the mortgage insurance industry, we do have a strong and continuing commitment to all borrowers and lenders to keep housing affordable to all borrowers. And, you know, that's our number one commitment. We continue to provide, you know, competitive mortgage insurance rates, educational tools, training to facilitate that home ownership, which we believe is the cornerstone of, you know, building individual equity and wealth as part of the American dream. And just an interesting fact, you know, for the 5th year in a row, Gallup reported that Americans picked real estate as the best long-term investment. And I think we keep seeing, even through all this pandemic, that consumer confidence just continues to be there with building and people still going out and buying homes during the pandemic. So as you all see, we're busy with the low interest rates and everything. And an interesting fact that I have here is that this year's result from the Federal Reserve is that 34% of Americans chose real estate, followed by 26% for stock as the number one investment. The average net worth of a renter is little over $5,000, while the average net worth of a homeowner is over $200,000. So as you can see, you know, the homeowner is, being a homeowner is still the number one way to build net worth and to build equity and net worth. So on the slide here, we do have on our website, we do have a COVID-19 frequently asked questions for anyone that wants to go there. There you go, as a resource. We have for our lenders, it's a great way to understand any way that you need to check out if you have a claim or something that you want to find out to deal with the CARES Act. You know, we're there to support you. We're here with you together. We're figuring it all out. But you know, with the CARES Act and the way that it is structured, tagging on the payments being added to the end and it not being, as Tim had explained, it is not a lump payment. It's going to be added on to the end of the mortgage. There's still a lot of uncertainty on how those forbearance payments are going to end up affecting the foreclosures and so forth. So a lot of questions, but as lenders and servicers, you know, we're here to support our customers, our lenders and borrowers. So, but there's a lot of good questions and best practices there on the website. So at essent.us, if we can help in any way, please reach out or use our website as a resource. We're happy to help. So if you have any questions.
Sue, a question for any of the panelists that may know. Do we know what U.S. Bank is doing in terms of forbearance? Are they adding the payments to the end of the mortgage in just additional monthly payments, or do we know at this point?
I do not know how U.S. Bank is handling forbearance with customers. I think with a conventional loan, they might just be adding the payments to the end of the loan. They're spreading it out over the entire loan. My son has a loan with the program, and when he originally called because he was laid off, they told him he has a conventional loan, that's how he could do that. Of course, with an FHA loan, it would be different, right? So.
Yeah, this is Tim. Oh, sorry, I was just saying, I don't know. I also don't know the answer to that. One thing we heard kind of anecdotally was in May, U.S. Bank had quite a few loans going into a forbearance, or at least forbearance being requested. We heard in June it dropped dramatically. Now, we all know, I mean, Florida numbers are spiking, our COVID numbers are spiking in Florida, so, you know, who knows what that could lead to July, August, September, et cetera. But I do know it seems like the immediate effect was a lot of people claiming it, and then it's kind of subsided. So the next few months will kind of let us know, but I don't fully know the answer on where they're making up the payments at this point.
There's a question that came in that Sue, I don't know if I'm happy to try to answer it if somebody doesn't want to. It says some municipalities temporarily suspended accepting applications for down payment assistance programs. Have you heard of funds being shifted from DPA programs to rental assistance or other new programs on COVID? I think we went through those on some of our other sessions. I know that on the multifamily, there was a discussion of a COVID rental assistance program that Hillsborough initiated, but many local governments are having COVID rental assistance programs, and also Florida Housing will be having a massive rental assistance program that will be available to people that live in Florida housing properties. So that was, sorry, just that was a question that came up there. So.
Okay.
So
right. Did anyone have any other questions? Okay, sorry, Tim, go ahead.
I had a question because I don't know the answer to this. I've seen various articles, but I mean, you three, the other panelists might have a better idea. I mean, who's buying homes right now? I've seen some articles that said millennials might be starting to hunt around a little bit more, but obviously with them, you'll probably have more of the student loan issues.
So Tim, it's Robyn. I'm seeing lots of millennials, lots of people, and I never know what the cutoff is. So people in their sort of mid-20s to mid-30s, but I'm also seeing some older people who've never owned a home. I've got a couple of people who are in their 50s and 60s, and I know that's not old because I'm there, but yeah, people who have never owned a home and are in their 50s and 60s and are buying homes. But for the most part, most of the applications that I'm getting for first-time home buyers are the millennials, the early 20s to mid 30s. So yeah. But also to go back for a second, Mark, to the DPA here in Pinellas County, what's interesting is the county itself, their DPA program suspended at the beginning of COVID, although I don't think it was from COVID, it was just they were suspending it anyway. And they are back as of July 1st. The Pinellas County program is up and running, doing DPA, and the other municipalities here in Pinellas that have DPA are still offering DPA.
Yeah, I think that most local HFA's DPA programs have continued, certainly.
I'm not talking HFAs.
Yeah, all right, I know.
I'm talking the local SHIP programs.
Yeah, well, many of them were suspended because they were running out of SHIP funds.
Right.
I mean, non-COVID related.
Right.
Right. Mm-hmm. Right. Okay. All right. So any other questions for any of our panelists?
If you look on the thing, there was a comment or question from David Westcott, Sue.
Okay. Oops.
Oh, sorry. I got it. It's separate one, and it was an answer to an earlier question. I'm sorry. He sent it to me privately.
Okay.
I apologize.
Okay. All right. Okay, great. Thank you. All right. So I don't see any other questions here.
Sue, is it okay if I share David's answer, because he answered what
Sure.
U.S. Bank is doing, and sorry,
Okay,
David,
great.
we're outing him for having an answer, but U.S. Bank is reviewing for extension of forbearance every 90 days. For those coming out of forbearance, they're doing their standard loss mitigation waterfall to see whether a repayment plan, putting the amount all on the back end, or short sale makes the best sense for their circumstances. I'm sure if there's more questions on that, we can get some more input from David. Thank you.
All right. Thank you. That was great. Okay. I don't see any other questions. I don't see any reactions from folks. I think that is going to conclude our session today, but I do want to remind everyone that on Thursday, once again, there's a kind of a continuation of this session where we're talking about the impacts. Where are we heading? What are the biggest changes? Carmen Lemberg is the moderator. It's at noon this Thursday. You'll hear from panelist Cindy Hayden, the chair of the Board of Realtors for the Pinellas Realtor Organization, and Sean Moss, the Director of Operations and Customer Support from Down Payment Resource. And I'd like to once again thank my panelists so much for joining me today. I cannot thank you enough for doing this. I know it was a little strange. Maybe next year we'll be in a ballroom somewhere in Sarasota, and we'll all be able to speak with one another and talk in person. I do miss seeing everybody, but other than that, please stay safe, stay healthy, and that's all I have for today. Mark?
Thank you, Sue and panelists. That was really great. I really appreciate it. And I think that, I think the oddest thing that we've all experienced is that while we expected a meltdown, we actually have had, for many of us, increase in our volume, where low interest rates and DPA trumped COVID, at least in the short term. So it's been an interesting period. But thanks to you, and for everyone else on, a reminder again, we have 2 more sessions this week. As Sue stated, we have the part B of single family on Thursday, and on Friday we have what I think is one of our great sessions on sunshine and ethics. So you can type private messages to me with your questions, so you don't have to out yourself with your ethics question. We'll have Mary Helen Ferris and Mark Mustian. And also Mark will be going through some changes to the special districts law that impact housing finance authorities, in addition to the ethics and sunshine. So again, this will be posted on the website by tomorrow. The PowerPoint is already up, and we thank everyone, and we'll see everyone on Thursday. Thank you.